So, ladies and gentlemen, you are welcome to our first lecture on financial management, one of the troublesome papers in the level 2. All right. Now, we want to start by looking at the first 4 chapters of this slide. So, we look at the introduction to financial management. Why are we doing this course in the first place? What is it all about? Okay, the word is financial and management. So I want to be under the impression that you people went through senior high school doing business. If not, probably you went through your first degree also doing, or diploma also doing business. So you've heard of the word management before. Yes, and we used to learn about 6 to 8 things: planning, controlling, organizing, monitoring, supervising, or blah, 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 all those. Now, it is the same here, except that we've added financial. So the word financial now brings in financial resources. Okay, so it talks about economic resources. So you'll be managing, but you are not managing human resource. You are not managing machines. You are managing financial resource. All right. So the 3 key things we know under strategy is planning, which is the formulation. It is implementation and control. These are the 3 key things under strategic management. And so it applies here too. So when we say financial management, all that we are trying to talk about is to formulate strategy, how we are going to, within the long term and the short term, manage our financial resources. And when we do that, then we implement it. Then later on, we evaluate it. Okay, so that is what it is about. So the management or the efficient acquisition and deployment. So when I say acquisition, it is part of the implementation stage. Okay, so we are talking about how you plan it, how you efficiently implement it or deploy the thing. Then later on, you find out that, oh, were you able to do it well to achieve whatever you wanted to do? So that is what financial management is all about. Of course, nobody is going to ask you what is financial management. So there is no need to memorize definitions, but understand what it's about. Now, the whole concept of financial management is treated under one assumption, one specific assumption. So everything that we are going to do throughout this course will be under that one assumption. And that assumption is what we call maximization of shareholders' wealth. Maximization of shareholders' wealth. Okay, so that is the main thing under financial management. It tells us that anything that we are going to do, we need to maximize the wealth of the shareholder. Why? Because the shareholder is the person who is putting his money into the business and he wants returns back. Okay, so whatever the management of the resources that he has given is about, should at the end of the day pay him back something. So, and that is what we call shareholder wealth maximization. I.e., if I put 1 cedi to start the business, then it means that I must get a return of more than 1 cedi. Okay, so that is very, very important. Please take this understanding, because it is the underlying factor of whatever we are going to discuss. And if you get to understand that this is how you are going to go about it, it makes the course very easy. All right. So that is what financial management is about. Now, the shareholder wealth maximization come by 2 main means. 2 means. Number 1 is that the market value of a share will increase. So it comes by measuring the market value. It will increase. So like I said, if I put 1 cedi into the business, which is my share price, the value of the share, I bought into the business. Then if that share I have now increases to 2 cedis, then it means that I have maximized my share, my value by how much? By how much? Yes. Yes. By how much?
1 cedi.
1 cedi. Thank you. By 1 cedi. So that is it. So if I bought, let's say I invest into MTN shares, and when the time that I was investing in it, it was 1 cedi. Then now the share price of MTN goes to 2 cedis. It means that I've increased my value by 1 cedi. And that 1 cedi is the profit I have, kind of. So that is it. Now move away from the shareholder. Most of you have done bank deposits, fixed deposits. You've bought treasury bills. What have you done? What you've done is that you put your money in the bank. Today, you put it in the bank like how much? Let's say 10,000. You expect that at the end of the year, that money will go like 10,500, which means that you have made a value of how much? 500. So that is where this thing is about. So wherever the person puts his money, he expects some return. Later on, you realize that that return price, not any return there, because it is payment for the time consumption. And then they find the time value of money. Yes, you realize that nothing has changed. It is just that time has increased the money. So we will go into that. All right. Then another way of increasing the shareholder wealth is by giving them dividend. You see, dividend is cash. Dividend is cash, but this one is share value. So there are 2 ways you can increase the shareholders' wealth. One, by paying him cash. So when the year ends, you pay him dividends. He collects the money. He's happy, but his investment is still there. He owns shares. You have just paid him dividend, meaning that the cash is still there. Okay, so that is the understanding you need to get. All right, it's very, very important. Now, with this said, I want to introduce to you 2 theories. Now, one theory is saying that we have what we call the dividend irrelevant theory. Dividend irrelevant theory. Then we have the bird in hand theory. Listen carefully. The dividend irrelevant theory says something interesting. It says that there is no need for you to pay dividend. It's irrelevant. There is no need. How do people pay dividend? They pay dividends when they make profits. Is that not it? When they make profits and profit is translated into cash, then they pay dividend. That is it. Is that not it? Now, the dividend irrelevant theory is saying that, do you need to really pay me dividend for me to have my value increased? No. Why don't you look for a positive NPV project? If you look for positive NPV project, it will be increasing the value of the company, i.e., the company will be making more profits. And the more company make profits, the value of the company increases. And so also the value of their share price also increases. So instead of paying me dividends, why don't you use the money for more investment in the company so that it will rather increase my share price? So the dividend irrelevant theory people say that we don't want the dividend. Find positive NPV project to do and increase the value of the company, thereby increasing the value of the shares. Please, does that make sense? Do you understand that?
Yes, please.
Yes, please, you are becoming financial managers. You have to think, okay? You have to connect and think. Now, the bird in hand theory is the Ghanaian theory. The bird in hand theory is saying that, what do you mean by finding positive investment project? I want the cash to spend. Or say, I should wait, find positive investment MPV investment project increase the value of the share. No. They said that if the bet is in your hands, you are so sure of what to do than the bet is in the air. So that is what they mean by the bet in hand theory. In fact, they go on to say that so what the mamia miankasa me find another positive investment MPV project. Now Mako investing in. So have you seen those two theories now? One goes for this. So this one is what? Which theory goes for this one among the two? Which theory supports dividend payment of cash?
The bird in hand.
The bird in hand. And the other one obviously goes for this. So please, that is it. So if you are asked to explain these two concepts, that is that. All right. Now, what I've done here is to try to tell you that the value of a company increases and thereby their share price increases when they have won a takeover bid. Because if you buy another company, it is assuming that you are expanding and you are going to grow. Your share price will immediately go up. Because Elon Musk and those people, you see, immediately Facebook bought WhatsApp, their price went up because more people will be using WhatsApp and it belongs to them. So that is that. So if you win a takeover bid, immediately the news itself increases your value. All right. So that is that. See, to even bring it to your level, if you get an employment right now, your mother or your father thinks that when you seek your level don't change. Akufo-Addo, for example, time now position, you know, that's why the moment you won into power, compare Akufo-Addo before president and compare Akufo-Addo as president. In fact, compare Cecilia Dapa before a minister and compare Cecilia Dapa as a minister. Levels don't change. So whenever you win a takeover bid, that is it. Winning a major contract is the same thing. It's the same thing. Because the moment people feel like you won a contract, hey, when your contract, why is it? That's how it is. Your share price goes up. Share buyback. I will explain share buyback to you because it is a little technical. Now look at this. I am sure if not all of you, some of you have idea about what earnings per share is. Earnings per share. So earnings per share is the earnings of the company divided by the total number of weighted average ordinary shares that they have. Watch this. I'm not going to bore you with that. We will look at those things as we grow into the course. But watch this. Look at this. 10 divided by 5. What is the answer? And 10 divided by 2. What is the answer? 10 divided by 5 is 2. Is that not it?
Yes, sir.
10 divided by 2 is 5, right? So this 10 is your profit. It's constant profit. Earnings. Then the number of shares is 5. So if profit and the number of shares is this, then it means that price per share is 2. If the company now buys back some of the shares and they buy that share back using their own retained earnings, when they don't find positive MPV projects, instead of paying dividends, you see, and please, I want you to connect the dots here. So instead of giving the money to the shareholders as dividends, they will now buy shares from the shareholders. Some, or maybe shareholders, no. So a shareholder who used to have 5 shares, no matter 3 or 3, no. So now, the share nebeba be saying, ebeba be 2. Omoto 3, no, they paid. They will pay money. All right. Then it will reduce the share to 2. They will do that for most of the shareholders. Then it will reduce the entire number of shares to 2. Now, when it becomes 2, what is now the value of each share? 5. Is that not it? Compare 2 to 5, you see it has increased. So whenever they buy back shares, from their own people, the value of the share of the company increases. That is what we mean by share buyback. Of course, we will look at that thing more in details when we get to acquisition and merger. All right. So that is that. I hope you understand this scenario I just did.
Yes.
All right. Of course, having a better than expected profit. If your profit grows, you grow. All right. All those things happens. Announcement of an attractive business strategy. It all happens. All right. Now, there are certain roles that you are going to be performing if you become a finance manager. All right. So these are the key areas. There are 7 areas, but we all know about the key 3. 3 of them are common, but they are 7. Most of the time, students are stuck with the 3, and when they go and they say state 5, 4, they are like, oh, what are the remaining ones? Yes, last 2 sittings, it happened like that. But they are 7. Number 1 is investing decisions. So you see, we've already talked about the fact that somebody has given his resources. You are going to manage it so that you give the person returns. We call that in increasing the shareholders' wealth. Now, you need to find investment to do with the money, the stated capital that the person has given. You need to find investment and pursue. Once you pursue and the investment is profitable, that is when the shareholder maximization thing happens. All right. And so the first, you see, it rotates. I'll ask you the key 3, it rotates among itself. Which one comes first and which one comes last? The key 3. One of them is investment decisions, and I'm going to explain it to you. The other one is financing decision. Financing decision. Then the other one too is dividend decisions. I'm going to ask you if one comes after the other or any of them can be the first. I'm going to ask you. So when I'm finished the first 3. Now watch this. The first one here that I'm talking about is investment decision. It means find what? Positive NPV projects and invest the money in so that the money, that the investment that you've done, the returns that comes can increase the shareholders' wealth. So what is the process of evaluating or going about your financing decision? We said that first of all, identify the project, evaluate the project, then select the project. This evaluation and the selection is what we would do as the investment appraiser decisions. Okay, we will do it later. So identify it, evaluate it, select the best alternative, then execute it. Once you execute it, then you monitor. Monitoring is control, all right? So that is that. So those are the activities there. Of course, you can decide to grow by either saving money and growing yourself, or you can actually acquire a company straight away to enter into the market. So you see, if you want to save money and do it, it takes a long time and it is slow. All right. So you see, I've done this thing here. Yeah. So you can invest in existing operations. It requires cash, and hence finance should be readily available. That is the only cash you have readily available as a company. It's always your retained earnings. Okay. And you stand a chance of using your existing staff and your system to do that kind of expansion. And you get some economies of scale, but it is slow. But when you buy another company, imagine that I want to enter into the banking system. It's either I build my own bank app or I just look at UBA and buy UBA. UBA already has the customers. So once I buy UBA, that is it. You saw Republic buying HFC Bank. You saw Absa with Barclays. So those are the immediately they enter into the new market. All right. Like I said, we will deal with this thing the more when we also go into acquisition and merger. But these are the things. But anytime you are going to enter into a market or a company or buy a company, there are strategic factors you need to consider. Please take this part serious, because later on when you go to level 3, these things are part of your case study analysis. So take them in with serious attention. All right. So now, you know Pestel, and you know Pestel, right? You know Porter's 5 forces competition. So this is it. You check your government intervention, check the reactions of competitors, check the demand forecast, the size of your competitors, technological changes before you make a decision. Because you can buy or invest into something now, then very soon government intervention can destroy everything. See, let me be as practical as it can be. I am suffering because I put my money into government investment opportunities. And we all know what happened to Ghana, domestic debt exchange. I can't even withdraw my money. Because if I'm going to withdraw my money, I will lose my money, part of my money. So we are saying that whenever you are coming to make such investment, look at the environment well, all right, before you go into that. All right, so that is investment. Then we talk about financing decision. Financing decisions is just about 3 things: source of the capital, the cost of the capital, then the risk associated with the capital. So those are what comes about financing. So you are going to source the money. You find the investment. Okay, no problem. So you found it. Wow, crazy. Okay. But how do you finance it? That's the next thing. So you find the source of the capital, the cost, how much it will cost you to have the capital, then the risk associated with the capital. So this is also another 15 mark. So investment decision is about investment appraisal. Financing decision is financing decision. When I was doing the syllabus breakdown, also for 15 marks. All right. So we will learn that one too. So the FM has that investment decision to do. Then we have the dividend decision. How are you going to, please take time and read this slide, all right? Because I'm not going to, all these things are something that you should consider, all right? We will later do more of that in the sources of finance. So that's why I'm skipping certain things. All right. So the dividend decision. Now, okay, you found the project, we financed it, then the dividend decision. How do you pay them? Are you going to use the dividend irrelevant theory, or you are going to use the bird in hand theory as the concept? All right, so that is how it is. That is how it is. So the dividend decision too is bad. But before you can pay dividend, I mean, check the company. Check the operating cycle of the company. If you start a company today, first year, you don't pay dividend. Come on. First year, company you can share down here, but how do you pay dividend? Also look at the project ahead. Are there available projects you need to invest the money in? If there are available projects, reduce the amount of dividend that you are paying. Check profitability. If you are getting more profit, then you can pay more dividend. Investors' expectation. I say I want dividend. I want dividend. You pay me, whether you have a positive NPV project there or not. Legal restrictions and covenants. Some of the loan agreement that you take make you sign that you will not pay dividends for some time. Then the tax laws. Whenever you are paying dividends, imagine there's withholding tax. All right. So that is that. These are the 3 key. I'll talk about the remaining 4. But can I ask you, which one do you think must come before the other? Yes. Yes. Fast.
Financial decision.
Financial decision. Okay, because you need the money before you can do the investment, eh?
Yes, sir.
That is it. Okay. Who else? Anybody? Anybody, please contribute. The class has begun. Don't go and sleep. You want me to call names? You want me to call names?
Sir, I think the investment would come first because you need to consider what you really want to invest in, how profitable it's going to be, and then that happens to do with the appraisal and all those things. So if you don't consider the type of investment you are going to go into, that would determine the amount of money that you should put into it. So I think the investment should come before the finance, because without the investment, you wouldn't know. Without the totality of the investment, you wouldn't know what you are supposed to invest in, the amount to invest into
You
the
will
project.
need to invest. Okay. Yes, Christabel.
I think the financing decision should come first. So for with the financing decision, you need to know the money that you want to raise for the investment.
So
Yes.
money comes
And
before
also
the
with
investment.
the investment decision, the financing should come before the investment. And with the investment, if it is worth using the money that you are soliciting for.
All right. Thank you very much. All right. I also think the dividend decision should come first, because it is the return I want that will make me give you the finance. And as you people are saying, the finance should come first. Then when you get the finance, then you can do your investment. It is also true that it makes common sense to also find the investment. Then you source the money to suit the investment. Then you pay back. So you see, it is a circular thing. Any of them can come first. So we call them the interplay of the three key management function, financial management function. So in the exam, they can tell you to explain the interrelationship that exists between the two. So any of them can come first. It is good to find the investment. Then you, and then I am a business plan. You will use it to go to the bank to source for funds. Then you pay back the returns to them. All right. So that is that. Number two, you can also get to have the finance. Then the finance, how much you have, can now determine the investment size that you can go into. All right. Then you pay the returns to them. Then the dividend decision is also that my expectation determines how much I can give to you for you to invest. So any of them can start. So there is the interplay between them. All right. So don't box your mind that one of them has to always start first. No, it's not like that. There is the interplay between that. All right. Number 4 of the management decision is about financial control and planning and control. So you are going to plan how you use the funds, both long-term and short-term and medium-term. How are you going to use the fund? The financial manager decides which type of loan he has to go into, how you manage the loan. And it is at this place we will learn something called working capital management, okay? So that is that, working capital management. So how do you plan the resources? How do you use the resources? How do you control the resources? All right, so that is part of it. All right. So like you see here, I've done here strategic planning. You do your forecast, budgeting, then the tactical and operational control, how you do that. You implement the use of the fund and do control. Control means comparing the budget with what? The actual, all right, to find variations, variances. Those of you doing MA, you know more about that. Then the 5th one is risk management. In all these things that the financial manager is doing, he's supposed to check the risk associated with the sources of funds. It is very, very important. Then the risk associated with every investment that he's taking, okay? If you want a risk-free investment, as it used to be, these days it's not like that. It used to be treasury bill. Now, even if you invest in treasury bill, unfortunately, Mr. Kenny Oforiatta can tell you that you are still at risk. So that is how it is now for us as Ghanaians. So the risk aspect is very, very important. All right. Is the business worth going in? You need to examine all those things. All right. So you have to manage the risk associated with all investment and the use of funds. All right. So there are 3 levels of managing risk. Number 1 is risk mitigation. What is risk mitigation? It is just using internal control process to avoid the risk, all right, or reduce the risk, like fraud, like stealing. You have to make controls very tight, all right? so that you can avoid the risk. Another way of managing risk is hedging. Hedging means taking an action today to predict the outcome tomorrow. So for example, I don't know the dollar rate now, but the last time I did last week, it was 11.3. Now, if you think that the dollar rate is going to go to 12 cedis, then what do you need to do now? What do you need to do now if you have a dollar? If you have a dollar and you sell, then it means you need to hold on to it. When you get to 12, then you sell. If you are going to use CD to buy, then you have to buy now because very soon it's going to increase to 12. So all these things, that is what we call hedging. You take an action today that determines the outcome of tomorrow. All right. So that is that. So if you hedge the rate at, let's say, 11 today with a bank, when it goes to 12, the bank will still sell it to you at 11.3. What have you done? You've actually locked the rate, and we will learn more about all these things when we get to risk management. All right. Then we have diversification. It simply means don't put all your eggs in one basket. Please, the ladies, it is not for you. It is an investment advice. When we say don't put your eggs in one basket, we don't mean that have many boyfriends. That is not what we are saying. You guys like doing that thing a lot. So please, it is an investment decision. When it comes to relationship and marriage, I beg you, put all your eggs in one basket. But this one is investment decision. So those of you who do kojo farming, just to, okay,
guys ni mom na yesa.
But you say what?
Guys ni mom na yesa.
Every guys in there, yes, sir. It is you, the lady. All right. So the sit one, sorry. The sit one is about communicating the policy to the stakeholders. All right. Every policy, financial policy that you have in your company, you are supposed to communicate it. You communicate to your internal people, which is your company employees and the managers. It has to be communicated. The financial plan has to be communicated. You also have to check the communication of that policy also against the connected people. But connected people, we talk about the equity investors, the customers, the suppliers, the finance providers, and all those people. All right. Because there has to be a policy around that. What is your policy for going for loan? What is your policy for the financial policy for you in terms of you and your customers? How many credit days? How many this? How many that? You communicate all those things. We will learn those things also when we are doing working capital. All right. And your external people are the government because they will take tax and also the community at large. CSR, no? Then pressure groups and all the regulators. These are connected. So know this external, internal, and connected. External is external, way off the company. Connected, they are with the company, but they seem also external. Internal is just your employees and management, all right? Connected is those that are around you, customer, suppliers, the bank, equity holders, all right? So that is that. Then the external is the government and the community at large, all right? So that is that. Then the last function of the financial manager is effective and efficient use of resources, all right? These ones are what we call the value for money concept. Economy, efficient, and effectiveness. What is economy? Economy is that you are getting the thing at a lower price without compromising on quality, all right? So you get the thing at a very cheaper price, but you don't compromise on quality. You say you can't cheap, not cheap. No, don't compromise on quality. What is efficient? When we say you are efficient, it is a ratio of your output to your input. The ability to use a limited input to produce more is what we call efficient. So efficiency is quantitative. We can number it. It's quantitative. Then we talk about effectiveness. Effectiveness is your ability to meet your set target. And the target can be both quantitative and qualitative. All right. So that is that. So these are the 7 functions of the financial manager. We'll move on to the financial objective of the what do we call it? Financial management. What are the objectives of financial management? We will group them into two. We will have, so let's look at the objective. We will have the financial objectives, and we will have the non-financial objectives. The financial objective, the very first one is what we have discussed, shareholder wealth maximization. That is the very first one. All right. Any idea what the second one will be financially? Yes, anyone? Anyone?
Profit maximization.
Profit maximization. Yes, profit maximization is also part. Yes, any other? As for shareholder wealth maximization, we've talked about it and how you measure that. You can use the market value, which is the share price. You can use statement of financial position. We will learn that when we are doing valuation and breakup basis when you are selling the company. All right, so that is that. Please, they've examined this thing before, that distinguish between shareholder wealth maximization and satisfaction. So I brought it in your manual over here for you. Maximization is seeking the maximum level. So enough is never enough. When you have one, the next time you want two. When you have two, the next time you want three. But when we talk about satisfaction, what did I mean? That is that. So all that satisfaction is just about a mere adequate outcome. All right. So you have some level, you're okay. You have avoided some risk. All right. You have reduced some workload and you are satisfied. But maximization is never satisfied. It is something on top of your satisfaction. And like you said, profit maximization is also part, is a financial objective. All right, then we have also earnings per share growth. So earnings per share growth. These are the profit or the financial objective. All right. Then we come to the non-financial. Yes, I have shareholder welfare of staff. All right, employee welfare is very, very important. Survivor is there. All right. So welfare of employees, management, have you seen that? It's also an objective. It's just that it's not financial. You want to make sure that they are fed well. All right. Provision of service. This is to your customer. You want to make sure that they are there. But there are issues of survivor. All right. And welfare, CSR. All right. There are issues of, what do we call it? Customer and supplier focus. Supplier and customer focus. All right. There are issues of that. All right. I remember when I was in senior high school, we discussed this one and this one. Non-financial and financial, which one should come first? Which one should come first? It was a WASI question for us under business management all the time. Yes, which one should come first? The financial objective and the non-financial objective. Which one should take precedence? Yes. Which one do you think will take precedence? Quick, so that we can look at the last aspect. I said I will not exceed 9 o'clock. We have 15 minutes to go, so we will look that one to look at our chapter 3. I think I'm supposed to add chapter 4. So please, quick. Which one do you think should come first?
I think non-financial.
Non-financial. You see, it's debatable. Hey, somebody to say financial. Those of you saying financial, if you don't deal well with your customers, if you don't survive, will you be able to pay all these things?
Mm-hmm.
So you see the entire relationship between that one too. The trade-off that is over there. Trade-off. Unya bako a untumi nya bako. Like unya bako at the higher, the other one will be lower. Unya this one at the higher, this one will be lower. So higher, lower. If you get this one higher, this like it's a trade-off, all right? So yes, you need to seek the welfare of your staff and all those things before. And somebody to say that it is the financial shareholder wealth maximization granting an FM crowd. If the shareholder doesn't see you maximizing his wealth, he can withdraw the investment. It is the start of everything. So on also financial number, you won't even be employed to start thinking about your welfare. So that is that. It's also interrelated. All right. So that is that. And we move on to our chapter 3 here, where we want to talk about the financial and other objective of the non-profit making organization. So we've looked at the financial for a profit-making organization and the non-financial. Let's look at that one for a non-profit making organization. What do you think is the objective of a non-profit making organization? Yes. What do you think is their objective? So something like the public sector and all those things. What do you think?
Value for money.
Value for money. So value for money is the objective of a non-profit making organization. And the value for money is the combination of the 3 E's. Is that not it? The 3 E's is equal to value for money.
Yeah. Economy.
Yeah. Yes, and I've already explained that, so there is no need to do it again. So the one that you add in terms of the objective should be transparency. As you are doing the 3 E's, let it be transparent. Ghana Economy is a non-profit making organization. How transparent has the government been? You and I can discuss that on another time. All right, so that is that. So I've already explained that, so that ends that one. Then we move on to chapter 4. At chapter 4, what we are doing is to talk about corporate governance and ethical consideration. Of course, this is not an audit paper, so we need not to waste much time here. When we say corporate governance, all that we are saying is that how the company is run, all right? How you run the company. But we are interested in this as finance management because of the concept of principal versus the agent. Like I've explained already, we have the principals being the shareholders. And they want shareholder wealth maximization. Is that not it? So that is what they want. Then we have the agent. The agents are the directors who are running the company. Please, most of the time, you people say management, but companies are run by directors, all right? Okay, so take note of that. So what are these people doing? These are the ones who are going to do the investments, the financing, find the financing, decide the dividend decision making. These are the people who are doing all the 7 functions, all right? These are the people, the finance director, all right? So these are the people who are doing the 7 functions. Now, we all know that sometimes these people can go wayward. They can decide to pursue their own agenda. It's true. I always say that compare the car of the business owner and the car of the CEO. Compare the two. Compare the two. Compare the car of yourself as the owner, citizen of Ghana, and compare the car that the agent that we have voted for to give us wealth. Compare what they are doing, the cars they ride. Have you seen the gap that is in there? The truth is that when they get there, they tend to do their own thing. There is an agency theory that establishes the relationship. It says that there is a relationship between the principal and the agent. Okay? And the principal is the one that has provided the funds, but don't have control. So this part is control, what we call ownership. And this part is what we call control. So these people own the business, but they don't control it. But if you have studied FR before, there is something called substance overfall. The person who controls the thing actually feels it's like he owns the thing. All right. So an asset is defined by your control power, not your legal ownership power. So it looks as if the company belongs to the agents. And so they run it as they see fit. In fact, as a matter of fact, you think you are the boss, the owner, but it is the agent that even decides the dividend that they want to pay you. And that is the agency theory. So the agency theory will breed the agency problem, which is when they decide to look their way. They forget that the business has legal owners, but they think that because they are controlling it, it is for them. So they decide to decide their own remuneration, like the way our government is doing. I don't know if you watch one of the parliaments, is it Congo or African countries? That a woman stood up and it was like, was ashamed being a member of the parliament because they were increasing their own salary against the welfare of the ordinary citizen. So that is what happens. Look at this empire building. Please, not to say this thing politically, but I feel like this government is building an empire, family empire. That's how I feel. That's how I feel. All right. Then they will be doing creative accounting. And our Pascal is here, BOG has made a loss. Okay, so that is that. They will be thinking of doing huge investment. I'm shocked to, in fact, if I talk about Ghana, I feel my heart, so let me even stop. Yes, they will be doing unethical activity. Imagine one person having $1 million for somebody to steal, or for us to know that there is extra 5. God will have mercy on us. Let's drop the bomb. Ebikrana Cecilia Dapa, family member, be joining this class, so you may never know. Yeah, but I also be a family member. I think I join this class. By this time, I was on UK or BBU. And umbrese. All right. So that is that. We have the agency problem. Please don't waste time at this place because it is not much of a finance management. You just have to read through for general knowledge. All right. So that is the one you are supposed to know is what I've already talked about. So the causes of the agency problem is because of the separation of the ownership and control. All right. The risk preference. These people are risk averse a little, but this part there or this can obey different goals. Different goals. We go a shareholder wealth maximization. We in your doing the bonus. I mean, then information asymmetry. When we say information asymmetry, I was speaking in audit the last time. I said that problem is because of information asymmetry. Because there wouldn't be any challenge in marriage if communication is always there all the time. All right. Yes. The ladies, because you have started seeing somebody who is trying to give you, who is telling you sweet words, you think where you are is a problem. But when we started saying sweet words. So the same product life cycle will happen to you. The same product life cycle. You will be having the sweet, you will be having growth, you get to maturity and you will decline. So it is the same thing. The same product life cycle will apply. Then you have to move on to another person, and move on to another person, and move on to another person. But information asymmetry is just because you see these people have more information than these people. As a matter of fact, these people are the one who will prepare an account for an auditor to come and audit before these people will get to know that everything that the agents have done is true and fair. All right. So that is what information asymmetry is about. It means information is one side, and until it is coming, the other side will never know about. That is what information asymmetry is about. Yes, sisters, now I'm communicate. Why? Communicate. All right. So how do you remedy this problem? You use hierarchical decision-making procedure, full board. Full board simply means that you are going to use the net and the x, balance them for off. The next is the non-executive directors. They are meant for supervisory activities, monitoring activities, and they are very independent. All right. So your board should have both executive directors and non-executive directors. The executive directors are, of course, the CEOs and the MDs and all those. But at least half of the board, all right, should be made up of non-executive directors. And the chairman should also be a non-executive director, all right, so that he can have exercise independence, sharp, very well. All right, so that is that. These things are pure audit issues, and you are supposed to have an audit committee, all right, and the audit committee will regulate the finance matters, internal controls, audit matters, and all those things. So you also need to also do performance monitoring, all right, performance monitoring. Do performance appraisal for your managers. Do it every year. Do all those things so that you will check, because what you need is what we call goal congruence. Goal congruence. Goal congruence, all right, to get them into the same objective for these people, all right. So that is that. So appraise them. Let us know how they are doing. Use ratio analysis, appraise the company, all right? So profitability, debt, and all those things. You have to. And please, we will be doing the ratios across the course, all right? It's part. When we get to working capital management, we will be doing the effective ratios. When we get to, what do we call it? Financing, we will be doing debt ratios more. When we get to acquisition and merger, we will also be doing ratios of investment, earnings per share, and all those things. The TEPS, all right, the theoretical express price, we will learn all this. Okay, so that is that. Then the last one is to manage the managerial reward. You see, these days, instead of paying cash bonus, people are using share-based payment. So instead of paying you bonus, we will give you share so that you become part owner of the company. They are not say, oh, you BBATR company now, you are also part. All right, so use that one. And sometimes too, they say that they will link your reward as a percentage of the profit. So it means that the more you work for more profit, the more your percentage will go up. You've learned about ethical issues and CSR, read about it. But the ethical issues is that anything that you are doing, do it ethically, all right? Please don't waste your time at this place. Don't waste time at this place. All right, these are not FM-based things. And when it comes to the normal principles that you learn, the integrity, objectivity, professional competence and due care, confidentiality, and professional behavior, that one cuts across all your courses that you do in IC. But don't waste time in this corporate social responsibility. Whenever it comes, I mean, you can write your mind over there. All right. So that is that. That is that. So I'm done with our first meeting. It's exactly 9 o'clock on my laptop. I know that it is 2 minutes to 9. So I am done. Any question? Any question at this point? So in our next meeting, we will finish this slide and we will look at more into the past questions. All right, we will look. I'm scrolling down because I want to get to the past question and let you know that they ask questions around the areas that we just discussed. And they do. The first 4 chapters, they do. So I'm trying to go down, and show you. All right, so these are the past questions. You see, this one is about ratio computation. Like I told you, immediately you need to learn how to calculate some common size ratios. I will show you. See, this is FM. This is the old syllabus, 2015. All right, that was how it was. But in 2019, they changed that kind of question. All right, this one too, we will learn. You see that it's all part of the slide. But I just want to show you where they examine the, you saw the agency problem? Explain it. You saw 3 practical steps to manage the agency. If you remember, we talked about full board. If you remember, we talked about reward schemes and performance appraiser. Those are the 3. All right, so that is that. And you see this, explain other non-financial objective that is pursued by a public limited liability company. Please, this public doesn't mean non-profit making. No. Public company is a company that trades its share on the market. It doesn't mean it's a public sector. So please take note of that. And it is asking you 3 other non-financial objectives. You remember them, don't you? Don't you? All right. So we will learn hedging, and this one is risk management. So when we get to risk management, this question particularly, you can be able to answer it there. All right. Then this one says, explain 3 approaches that corporate governance has identified for addressing conflicts. And it's the same question as this one. All right. Where are you? Where are you? Dealing with the agency problem. All right. It's the same question as that one. It has similar similarities in them. All right. So we come to 2017. It asks about the value of money. Then it asks you to explain the 3 E's. Then it said compare value for money against corporate value maximization. You remember this, the fundamental issue underlining FM, wealth maximization. So it's the past question asks those things. By the time you finish, you should be able to answer them. Explain 4 examples of non-financial objective of a private company. We mentioned them, so be ready for them. All right. So that is that. When you come to the new syllabus from 2019 going to have places there. So you see financial, you are supposed to suggest appropriate measure for financial. So this ratio analysis, economy, efficiency, how do you measure them? All right. So that is that. It also, we will look at the money market so that you can be able to explain all these ones too in our next meeting. All right. So that is that, the functions of SEC and all those things, you will go through all of them. But read in advance so that it will be an interactive question and answering session the next time we meet. All right. So read in advance, non-financial, financial. If you are serious for this course, you should by now get a form maker or an exercise book where you sit down and write your answer, not just reading it and probably saying it with your mouth. Write. If you write the answer, there is no way you forget. If you write it, it's not possible you forget. All right. So that is that. Go through it. Explain shareholder value maximization. Explain why shareholder value maximization is considered more appropriate than profit. You will learn that. You realize that profit is subjective. Profit is manipulative. All right. People, accounting policy can make people manipulate profits. You've heard of earnings management before. So shareholder maximization is the right way to go. If you make it profit people will manage their profit. They will do creative accounting. Shareholder wealth maximization gives us goal congruence. All right. So that is that. And you say explain 3 non-financial objectives. That's just last year, April 2022 year. All right. And this one too, the same. You see the trend, August 2022. All right. So the person who wrote these exams, who had gone through this past question, should be able to answer this one. All right. It's possible. Only that they made this one public sector. They explained the 3 core objectives, which is the value for money. Then they said distinguish between financial objective and non-financial objective. I mean, it's all there for you. Okay, so come on. Yes. At this point, I am done. My time, I've exceeded my time by 3 minutes, but I would add 2 minutes and ask you people, if you have any question, just ask before we draw the curtains for today's class. I hope the class was fruitful. You can be able to answer some questions. Yes, any question at this point? If there is not, thank you. God bless you for joining